when a business owner dies, they're deemed to have sold all their assets at fair market value. That can trigger a significant capital gains bill. What are some strategies that you recommend for business owners to mitigate that tax bill?
The most common one that would come up would be carrying out an estate freeze. So I would have that conversation with clients where they have corporate interests, there's value in there. And as you said, that value is going to be taxable as a capital gain. So if they've got shares in a company and there is growth in the shares, maybe they started a business, so it started with zero value, but now it's worth $1 million. And so that growth to $1 million is taxable on death as a capital gain. And on today's numbers, loosely it ends up being about 25%. There's not a ton we can do about that, but if there's prospects of growth, then all that future growth as well, if we do nothing, is also going to further capital gains and it'll be a larger tax hit on death. And there is a way to freeze out the value today so that the growth is then captured through a separate entity, usually a trust. And now we can plan around the taxes, and then all the growth we can address at a later date. So you can run it through a family trust for 21 years and either shift it out to your kids or whoever your beneficiaries might be at that point, and then put additional capital gain accrual into their hands so that it's effectively skips a generation on when it's going to become due and payable, or take it back depending on what the circumstances are at the given time.